Hello everyone, this is Steve Sun. I'm with Keller Williams Silicon City. Today's show is about how to use the equity in your home to buy another home. Let's dive in. Coming up with enough money for a down payment is often the biggest struggle that most would-be homeowners face. Actually, this is a long asked question. I get asked by a lot of my clients, friends, family members. They keep asking me, I have a home right now, but it's not big enough, or it's not in a super decent school district. How can I buy another one, a new home? Do I have to sell my current one? Or what's the best way to work this out? Well, today, let's talk about one case, a situation where you've paid a good amount, a good portion of your first home mortgage off, or where your home value has increased pretty significantly, a lot, after you bought it. And how can you leverage on top of that? Then, well, home equity loan is a good option, or HELOC, both of them. Home equity loan is a loan that you take from a bank that is secured by the equity in your house. Well, it might be confusing for you, so let's break it down. For example, if your house is appraised at $1 million, which means your current home worth, which means your current home is appraised at $1 million, and you owe 200,000. Therefore, if you've that means you've got 800,000 spread between what is worth and what you owe, and that is called your equity. For example, $1 million house, and you have 200,000 mortgage that you still continue to pay every month. That means 1 million minus 200,000 that you currently owe, 800,000. That is your equity. We're just using that as an example. A bank or a credit union will allow you to take a loan out of it, secure it by your equity, which means if you don't pay, they are going to take your house from you. Typically, they will give you a percentage anywhere between 70% up to 90%. So let's continue to use the aforementioned example. Let's say a local bank or credit union will give you an 80% LTV, which stands for loan to value ratio. That means your house is currently appraised or worth $1 million. We take the total 80%, which is 800,000. 1 million times 80%. That is 800,000. That is a loan, the total 80% loan to value ratio that they can give you, that they will allow you to take out. But remember, as we said, you currently owe 200,000. That is your first mortgage, right? So you have to deduct the 200,000, your current mortgage, from the total equity that you can tap into, which is 800,000. So 800,000 minus 200,000, that is total 600,000. That is something that you can borrow. You can either cash out refinance, you can make a home equity loan, or the best way, in my mind, is to use a home equity line of credit. Well, note there are some differences between a line of credit and a home equity loan. A loan is just in common sense. A loan is usually at fixed rate. It's usually a set amount of payments until you pay it off. However, a line of credit, it's a new term, but you might be very familiar with it. It's basically working pretty much the same as your credit card. It works pretty much the same way. You have a whole amount that you can borrow from. You can borrow against that upper limit. You pay it back. You keep borrowing it, right? And then you keep paying it back. You have to pay it back. And usually, for HELOCs, it usually has to be your primary residence, which means the home that you actually physically live in with your family members. It's very difficult to get a loan on your rental property, on your investment property, because banks or credit unions, they work on the premises that investors or non-owner occupied properties, people tend to default more. They're more likely to default. So lenders, they are more okay to give you a HELOC or home equity loans on your primary residence. So it's very precious. It has to be your first home. It has to be your primary residence. So use that wisely. And a few advantages or a few upsides why I think HELOC or home equity loan is great. Number one, it is very fast. It's almost equivalent to cash. So think about how powerful that is. That gives you a lot of advantage. say, for example, if you want to buy another home, say the new listing is listed at 500. Use the aforementioned example. You have 600,000 line of credit or home equity loan. You could have that money. You could basically write a check to buy that property. Then you could compete against other cash buyers, other cash investors, and that's going to make your offer really attractive and competitive, because basically you don't have a loan. You are a cash buyer, almost equivalent. Then you can close very quickly, and then the seller is happy as long as you close quickly, right? That's going to make your offer very competitive. And also, it's a pay for HELOCs. Is pay, you pay as you use it. It's sitting there. It's just a pile of cash. If you don't use it, it's just like your credit card. If you don't use it, you don't have to pay anything. And also, another thing is that, in my mind, this is one of the best money to borrow from. You don't have to beg any other people, right? For example, hard money lender. This is your own money, just sitting. You are sitting on your own pile of money. So use that if you really need to. And another good thing about it is really cheap. The interest you pay to your home equity loan or credit is usually 5 or 6 or 7 or 8%. But the interest that you pay to a hard money lender could easily go, but actually it's usually in the double-digit range. Of course, it varies based on your credit history, a lot of other factors. But also, keep in mind a lot of some downsides of something that you do need to keep in mind before you open up your HELOC or you decide to tap into your home equity is, if you don't pay, similar to your mortgage, if you don't pay, you'll lose your home. Because basically the reason the lender is willing to give you that money is because they are using your home as the collateral. Remember that. It's actually, so it's working almost the same as your first mortgage. In fact, people often refer to home equity loans as your second mortgage. So it's basically the same principle working as a mortgage. Another thing, be serious, be very serious. Do your math right. Calculate your repayability. Either HELOC or home equity loans, your house is the collateral to the bank. If you don't make the payment back on time, you'll lose your house. Another thing to note is that having usable equity doesn't usually mean that you are guaranteed that you'll get access to that fund. Some lenders do take into account of other factors such as your income, your job stability, your work history, your age. A lot of other things come into play as well. So keep all of those factors in mind before you really decide to open up a HELOC. So that's the tip I would give today. That's all about for today's show. If you really like our show, please give me a thumbs up. That means a lot to me. And also don't forget to hit the subscribe button. I'll see you next time.